Hey everyone, my name's Andy. My channel is Finding Value. If you like making money, looking for undervalued assets, talking about commodities, this is the channel for you. Subscribe to the channel. Give me a thumbs up for the content if you like the content, and leave questions and comments below about anything. Sometimes I answer questions and comments in the comments section. This one is answering one of the questions that somebody had. It's about real estate. They were talking about, well, actually, I'll get into it and read you the question that they have. So this is real estate and my opinion on it. So from here, real estate's an asset. So from a cash flow perspective, if you don't own your house and you're renting and you don't rent it out, it is a liability, and I agree with that. But I'm looking at it from a different perspective than just a cash flow perspective and an asset liability standpoint. So let's look at it from an inflationary scenario of buying real estate and living in it. Would it be a good idea? I think it is, and I'll describe why. So this is what I propose in a housing deficit market like we have today, with 4 million homes short and inflation coming from the real estate market. What I did myself is I locked in low cost. I locked in my costs at a low interest rate. I think it was like around 2.75. I think is what I have. And in a real negative rate environment, where inflation is greater than your interest rate, you're going to pay the house back with devalued dollars at a rate that is devaluing more than the interest you are paying on the loan. So if your inflation is greater than your interest rate on your loan here, you're actually paying less back on the loan than what you loaned out. And I'll show you what that looks like in an Excel spreadsheet. But to go in here, what you're essentially doing is making a leveraged bet. You're essentially making a leverage bet on your house for house appreciation. You're paying back the loan with less money over the life of the loan, given that's the net present value of the loan. You have a fixed cost and is stable and predictable when inflation is high. So that's another benefit that you have. And if you have a choice and you're looking at this and you say, okay, I'm going to rent a house for $2,500, or I can buy a house for $1,200, the same house, why would you not just buy the house? And that's what I did. Your costs are half the costs, and you can have a house that can appreciate quite substantially, which it already has. And now homes here, at least, people are starting to bid 100,000, 150,000 over asking price. So we have a huge shortage in homes. And you can lock in your costs and have a known, stable, low cost. I would do that. Now I'm going to bring up the Excel spreadsheet here, just to show you what it looks like. These are the given at the top. The loan amounts, I just chose a number, 300,000. Monthly payments, 1225. The assumed 5% inflation rate is what I assumed, and I think that could be low. And then an interest rate that you could easily have gotten was 2.75%. So the $300,000 loan, this is what your payments look like each year. They're stable. Your total dollar cost over the entire life of the loan is $441,000. But if you have a 5% inflation rate, we have to discount that back at 5% to a net present value of the loan. The net present value at 5% is $225,000. So what you're doing is you're taking a loan out for $300,000 today, and you're paying it back with dollars that are valued at $225,000. So you're paying back the house with less money in terms of the purchasing power of that money versus the loan that you took out today. So you're actually benefiting from it. If your inflation rate is greater than your interest rate, you're paying the loan back with less money than what you loaned out in the beginning. So that is what that's why I did it. You start doing the math, you're like, well, I can pay this loan back if on a 2.75% interest rate loan. If inflation's anything greater than 2.75%, you're paying less back over time. So in this scenario, if you're a very disciplined person and you save your money instead of spend it, you'd want to actually never pay the back loan early, because inflation is going to erode it. That inflation, if you can get better returns somewhere else, It's a twofold thing. One, you pay back less on the loan if the inflation rate is higher than the interest rate on your loan. So you want to push it as far out into the future as possible, your payments, because then when you discount them back, you're paying less back in terms of purchasing power dollars. And another thing is, if you have more savings and more investments and something does happen, you're better prepared to last a longer time paying this payment off than you would if you sunk a bunch of money into the house and you keep lower cash levels, either cash or investment levels. So then it becomes a game of how long can you float bills. And it's better to have a bunch of investments. Let's say rather than putting $200,000 in a house, you have $200,000 in investments, or maybe it's $400,000 now that you were in investments as it has gone up. You can use $400,000, and if you lose your job, you can pay back that house or keep the payments going for a very long time. So that's the way I view it. This is not financial advice. I'm not telling anybody to do this, but that's how I view things. I look at a house and I want to pay it back with dollars that are worth less. And then I want to be able to have a bunch of cash and investments and whatever where I could last 10, 20, 30 years if I were to lose my job. If you guys like this content, give me a thumbs up. Appreciate you guys listening. And thank you for listening. Yeah, this is Finding Value.